It sets out the principles and concepts, it sets out the concepts that underlie the preparation and presentation of financial statements for external users. It assists the IASB in development of IFRS standards. Is that clear? Meaning? Okay, now, so we said there are various chapters. So first, just only the main things we're looking at. What is the objective of general purpose financial statements, financial reporting? For any financial statements, are there many users? If an entity is publishing financial statements, is it for a specific user or anyone uses it? Who are the users?
External and internal, both users.
Yeah. Can you name a few users?
Lenders,
shareholders, investors,
lenders,
Shareholders.
stakeholders,
Yes.
authorities,
Basically,
Creditors.
from the sole proprietor to a
public.
company.
Yeah. So anyone is a stakeholder who is interested in the affairs of the company. Everyone has interest in the financial statements of the company. So the objective of general purpose financial reporting is to provide financial information about the reporting entity. Who is the reporting entity? Any idea? Who is he?
company.
It's a company.
So if I am talking about Alpha company's objective of preparing general purpose financial reporting, Alpha is a reporting entity. If I'm talking of Beta's objective to prepare, Beta is a reporting entity. So objective of general purpose financial reporting is to provide financial information about Alpha or Beta that is useful to whom? Investors,
Stakeholders,
lenders, creditors in making decisions relating to providing resources to the entity. But we very well know that all of them have got different needs. You agree? What does the investor want to know? The investor wants to know the profitability of the company. The investor wants to know about the dividends of the company. What does the lender wants to know? About the liquidity position. The creditor also wants to know liquidity position.
Yes.
So you can see all have different needs, but generally the IFRS or most of the financial reporting framework concentrate on the needs of your shareholders and investors. They concentrate more in the way in which we do the financial reporting is to cater to the needs of the stakeholders in the form of investors or shareholders. So now we come to the second chapter of that qualitative, the characteristics, of the conceptual framework, which relates to qualitative characteristics of useful financial information. That means whenever you present any financial information, it should have certain qualitative characteristics to be present there. What are they? So basically, there are two qualitative characteristics. One is called a fundamental qualitative characteristic, and second is called an enhancing qualitative characteristic. Fundamental means which should exist on prime books. That means if you want to record an entry into any prime book, it should satisfy the fundamental qualitative characteristics. Can you tell me what are prime books? Prime books of accounts means what?
Journal, ledger, cash book, bank book.
Trial balance.
Journal.
No. Trial balance.
No. Not trial balance, not ledger.
Yes.
Primary.
General
First, where do you record?
Journal, cash
journal.
book, bank book.
Journal.
Cash book,
sales book, journal,
Sale
book,
sales day book,
Yeah, sale book,
and
purchase book.
purchase day book.
Mm.
These are the prime books. From here only it goes anywhere else. So while you record here, there should be some quality in the information. Then only you should record it. If the information does not have that quality, you cannot record it. What are those qualities? It is based on two concepts. All of you are advised to keep your mic on mute. What we can do is when you have any query on your mic. Okay. As in when you have queries on your mic, otherwise keep it on mute always. Because some background noise comes, then it is causing a little bit of disturbance, and even later on when you listen to the recordings, you may not be very comfortable or not be able to hear properly. Okay, so now when I'm looking at the qualitative characteristics fundamental, that means on my prime books, when I record, what should be there in that information? Two basic qualities is relevance and faithful representation. Relevance and faithful representation. If you're going to record it, there should be relevance. Relevance means what? Relevance is not English relevance. There's a reason. First, it should have a predictive value and it should have a confirmatory value. Confirmatory value is straightforward. That means you should have some kind of a proof of the transaction. So when I purchase goods, is there a proof of the transaction?
Invoice.
Not only invoice, you can have your purchase order, goods received note, invoice, inspection report, everything. So that is confirming that this transaction is genuine and it took place. So if you want to record anything in prime books, there has to be a proof of the transaction. That is the first. Second, it should have a predictive value. All items that you record. Now, when we prepare financial statements, are we able to prepare a trend analysis of our revenue? Trend analysis?
Yes.
Of what we can do of revenue? We can do of our profits. We can do of maybe operating expenses. We can do of our working capital and so on. So how does that come? How am I able to do? Because all these have some predictive values. You agree or no? When someone will record any sales in the book, are we able to challenge this is not possible? If suppose you find some recordings on a cash book or a sales ledger, if you find some books without even going into depth, will you be in a position to say this is not possible? Or do you have to go and look at the proof to say, yes, this is there? Without it, just a feel. Can you get a feel of whether it's possible or not possible? We do get, right? In the time of the pandemic, if you were at the time of the pandemic and someone who was selling capital goods said he made fantastic good sales, would you believe him?
No.
Whereas if a pharmaceutical company in that time told you he made good sales, you would believe him, right?
Yes.
Yeah, definitely.
So, yeah. So you must have a feel that, or rather, every item you have should have a predictive value. So that even if you don't look at the documents, final figure when I see, I should be in a position to say, looking at the operations of the entity, this is possible, not possible. So that is a concept of predictive value, but it is all based on materiality. Can anyone tell me the meaning of the word materiality?
Physical facts.
No. Is anyone an auditor here among you?
Quantum as compared to
material
overall
impact
volume.
in terms of values. Yes. Material impact in terms of value.
Materiality
Not
has
necessary.
importance.
Materiality is if there is a misstatement that may affect my financial decision. That is what materiality is.
Any information
Materiality
and
means
essence of which is which
does not impact on the user of the financial
financial
statements.
economic decisions of the users of financial statements. That means if you make a mistake, suppose you make a mistake, it may be a genuine mistake, and you record the financial statements with a mistake in your sales, in your expenses, in your profits or some area. If you publish those financial statements, the economic decisions made by the users, if they are affected because of your mistake, it's said to be material. But if they're not affected, then it is not material. That is the concept. So this materiality is not always in values, it's also in terms of the nature. For example, if I don't disclose related party transaction, it is material by nature. That time we don't look at values. You may have a director with whom you did not have any transactions during the year. So you would say that there are no transactions, but I still have to publish or be aware of who are my directors of the company. Okay, I need to make some disclosures about who are related parties of the company. So that if you make mistakes on those disclosures, it's said to be a error of nature, which is materiality by nature. Okay. Anyway, that much, we don't need to get into that much details. It's just to give you an overview of what the qualitative characteristic of relevance is. Now we look at faithful representation. Faithful representation means to be fair. In short, if you're told by anyone to manipulate financial statements for whatever reason, as an accountant, you have to understand we need to be fair to all users. We cannot do it to suit any specific kind of user. So if you are told to manipulate it by a person, whoever, whichever place he is in, you're doing it to manipulate it to suit one person. But as accountants, we have to act in public interest, so we cannot do that. We need to be fair, unbiased. That is the meaning of faithful representation. And while doing this, we have to also ensure that transactions are recorded in accordance with substance over form. What is the meaning of substance over form? Any idea? Okay, now, if suppose an entity issues a redeemable preference share, is this going to be recorded in equity or is it going to be recorded as a non-current liability? Where?
Depends upon the term.
Equity.
Okay. What is
Depends
the
upon the
meaning
terms.
of the word redeem? No terms. What is the meaning of the word redeemable?
Can be converted.
No, I didn't say convertible. I use the word redeemable. What is the difference between redeemable
He
and
can get the
convertible?
refund for that.
It
Yeah.
can be redeemed against money.
After some years, we can redeem.
Is it that it can be redeemed or it will be redeemed?
It will be
It will
redeemed
be,
and it will be recorded in liability.
Okay, 1 minute. So the point here is when I say redeemable preference share means it is like someone making a borrowing for the company, a company making a bank loan. What are the terms of the loan? You have to pay interest, and when the term is over, you have to return back the money. So when I use the word redeemable preference share, in legal sense, you call it a share. So someone will say share is equity. But no, you have to record it how the transaction will behave. The economic substance should overtake the legal form. So I have to record it in the books as a non-current liability. So that's an example of substance over form. So when you're recording the transactions, always bear in mind substance over form while doing so. Is that clear?
Yes.
Now, while doing it, there are 3 qualities we must remember: complete, neutral, free from error. Neutral means what? Being unbiased, right?
Yes.
Not to take any sides. Over and above that, also it is okay. That is neutral. Now, complete means record everything. Don't miss out anything. Don't make errors. But of course, when you're recording so many transactions in a company's financial statements, don't you think errors can be possible? Human errors? Possible or no?
Yes.
Possible. So nobody can say that my financial statements don't have any errors. So while doing that, again, we take into my account materiality. And if we feel that the error is too small, we might ignore it. But if it is a material item, we cannot ignore it. Everything has to be recorded, and errors which are going to affect materiality have to be corrected. Is that clear? So that is a fundamental qualitative characteristic. Now comes the enhancing qualitative characteristics. When I use the word enhancing, means it is adding value. So this refers to the financial statements that we publish. The balance sheet, the profit and loss account, cash flow statement. There should be some qualities in what we publish. It should be comparability. All of you would have noticed that when we prepare a balance sheet, we prepare current year and previous year's figures. Yes or no? Have you all noticed or no?
Yes.
A balance sheet, a profit and loss
Yes.
account.
Yes.
We show
Formalized
figures
balance
of. So why are we doing? Because the accounting, the conceptual framework says that there should be a comparability characteristic of that financial statement. So we make it comparable. Second, we make it timeliness. We publish it every 12 months and within a time frame we publish. We don't delay it. Every year, 12 months. So it becomes easy for us to understand the financials. Third, don't you find that all financial statements have to be prepared in a way that it is understandable? When I use the word understandable, I'm not saying a person having no accounting knowledge will be able to understand it. But I'm saying people who have a fair amount of accounting knowledge will be able to overall understand what goes in that financial statements. And lastly, verifiability. Now, when you have, suppose you have inventory, suppose you have an office building. Can we not look at it physically and confirm? You put in the balance sheet, I can see an office building there. Yeah? Yes or no?
Yes.
So verifiability is very often items in your balance sheet have got a different way of even being found out without going through documents. So if that is the case, that feature should be there in your financial statements. Okay. So these are the qualitative characteristics of useful financial information. Now we go to the presentation of useful financial information. How are the financial information presented? Do we have a statement of profit or loss containing assets, liabilities, equity, which in India is called as a, what do you call it in India?
Balance sheet.
Balance sheet.
Balance sheet.
So in India, it's a balance sheet. Then you have a statement of profit or loss and other comprehensive income, SOPL and OCI. As the session progresses, I will tell you what it is, but for now, just remember it contains income, expenses, and it also contains some reserves which are related to equity. Then you have statements and notes, significant accounting policies, notes to accounts, cash flow statement, and also one more statement is a statement of changes in equity. I will run you through with this in the form of the how they look as we progress on the sessions. Okay, so these are the basic financial statements. We have to remember financial statements are prepared assuming going concern. That means a entity will continue to operate in the foreseeable future. So for accounting perspective, 12 months, the next 12 months after the reporting period, entity is expected to continue to perform. So that's a going concern status of the entity.
Ma'am, can you please pardon that SOCIE? What was that?
Statement of changes in equity.
Thanks.
The changes that take place in the equity section of our balance sheet from the start of the year to the end of the year, which I will discuss as we proceed. Okay, it was missed out of this slide. Now comes the elements of financial statements. When I use the word element, means asset, liability, income, expense, equity. The meaning of the word element is this. First, asset. What is an asset? First of all, always it is as on a reporting date. Do you agree with me?
Yes.
Another word for reporting day is the balance sheet date. So whenever I talk of an asset, I'm referring to it as on a particular day. So that is why we say it's a present economic resource controlled by the entity as a result of past events. So then what is an economic resource? It's a right that has a potential to produce economic benefits. Right that has a potential to produce economic benefit. So suppose you have gone to a trader and you had a purchase order for 50 pumps. This happened on 1st of January. On 15th of January, you received the pumps. Now, if my financial statements are prepared as on 1st of January, let's assume, okay, just a hypothetical. Or you could call this as 31st of December if you find it strange. Can I take this pump into my inventory?
No.
No. No.
No.
Okay. So why would I take it on 15th of January and not on 31st of December? Because if I want to take it, first of all, it has to be an economic resource controlled by the entity. What is an economic resource? The right that has a potential to produce economic benefits. So when does that inventory give you economic benefits? Can it produce economic benefits before you got the inventory in your physical possession?
No.
No. So
No.
this happens only on 15th of Jan. So an economic resource is a right. No, 1 minute. It is a right that has the potential to produce economic. So even I could say that the pump has the pump, I'm not talking of the day. The pump is an economic resource. Why? Because I can sell and earn profits. Yes or no? So it has a potential to produce economic benefits. So pump can be an economic resource. But when does it become my asset? When it's a present economic resource that is controlled by the entity as a result of past events. So I can control the entity on 15th of January because of the past event that I have purchased it. Then it becomes my asset. Is that clear?
Yeah.
So on 31st of December, it is not in my control. There is no past event of me purchasing it. So I cannot say it's my asset. Is that clear? Now a liability. Again, it's a present obligation to transfer an economic resource as a result of past events. Obligation means you have to, obligation to transfer economic resources in short means to pay money. You can even transfer some asset because of the past event. So suppose there is a credit purchase that took place. The day of the credit purchase, you have an obligation to pay the money because of the past event of your purchase. So the day when you purchase the goods on credit, it becomes your obligation. So simultaneously, you will create an accounts payable or a creditor in your book of accounts. Equity, it's a residual interest in the asset of the entity after deducting the liability. So asset minus liability. Income. Now, when I talk of income, it can be increase in asset or decrease in liability that result in increase in equity. Other than those relating to holders of equity claims. So let us imagine that we sold goods for cash. When I sell my goods, do I get any asset with me? When I do cash sales, is any asset coming to us?
Cash.
Yes.
Cash.
So there is an increase in asset. So one has happened. We don't need to look at decrease in liability, either increase in asset or decrease in. Now, because of the sales taking place, will it increase my profits? Will it affect my profits?
Yes.
Yes.
There is going to be increase in profit. And is that profit coming? Is the transaction to do with anything with shareholders? When I do a cash sales, is that a transaction with the shareholder?
No.
So if it is a transaction with shareholder, you cannot take it as income. If it is other than a transaction which is going to increase your asset and it's going to increase your equity, but it is nothing to do with a shareholder, you can consider it as income. Is that clear?
Yes.
Yeah.
So now suppose I issue shares for cash. What has happened? Did I get cash? One took
Yes.
place, increasing. Does it affect my equity section of the balance sheet?
Yes.
My equity will
Yes.
increase. But is it from shareholders?
Yes.
This is yes. And that is why this is not income. Is that clear? It is not a question of no profit, no loss. It is going to directly, it doesn't change any equity. Yeah, it will not change an equity, but it is going to be recorded in your books. How do you record it? So when someone is asking you what is the treatment of selling goods when there is no profit and no loss? Basic sales itself is increasing your profits. Whether you sell at a profit or loss is not what you're talking about. Is it going to increase your equity? Is it going to decrease your equity? That's it. So if it is not increasing, not decreasing, you will show the sales, you will also show an expense. I will show once a sale. With the sale, it will increase my profit. I will show an expense because it's no profit, no loss. So that will decrease the profit to the same extent, and ultimately it will become a zero. The basic sale itself, whether you are selling at a profit or loss, it's going to affect your equity. The sale transaction is going to increase your equity. The expense recording, the expense that you record against the sales is going to decrease your equity. The net effect is equity change, no change. But the basic sale transaction, even at a loss, is going to increase your equity. You agree or no?
Yeah, ma'am.
Whenever you sell the goods, it is increasing your equity. When you record the related expense, if it happens to be the same as thing, it will decrease your equity, and the increase and decrease is the same. That's the thing. So from the point of view of a sale, there is increase in equity. Okay, that's it. And expense is exactly the reverse: decrease in asset or increase in liability. That result in decrease in equity, other than those relating to equity holders. So what do we mean to say? Suppose you pay salary. I am going to decrease cash. Or if it is salary payable, we are going to increase a liability, which is your salary payable. Now, when I pay the salary, it will decrease my equity. And it has nothing to do with my shareholders, so it is expense. But if I pay dividend, cash is reduced, asset is reduced, which is going to decrease my equity, but it is with shareholders. So dividend is not an expense. Is that clear?
Yes.
Ma'am, why this dividend will decrease equity? Like we are paying it to equity share and share capital will not reduce because of payment of dividend.
Okay, can you tell me what is a breakup of equity? What is equity made up of?
Share capital, reserves, retained earnings, P&L appropriation for the year.
Share capital, share premium, retained earnings, and some reserves. So when I say decrease in equity, I don't mean share capital. Retained earnings will reduce with the dividend.
Okay.
So overall equity will reduce.
Okay.
Yes, ma'am. Got it.
Okay.
Okay.
Ma'am, just picked out.
Yeah.
What exactly mean by residual interest in the equity? Residual interest.
Where is residual?
In the equity.
Residual means leftover, asset minus liability. Residual means leftover. Interest of the asset after deducting liability. Asset minus liability is equity. That is the meaning of the sentence.
Okay.
Equity is equal to asset minus liability. That is the meaning. Okay.
Thanks.
Now we come to the recognition of the elements of financial statements. This is a general recognition criteria. Recognition means generally it is a timing of recording. Srinivas, you cannot say equity should be thought in terms of retained earnings. Equity should be thought in terms of share capital plus retained earnings plus reserves, everything, share premium all together. You can't talk of it individually. In many of the transactions, it's retained earnings, but it could be any element. Okay. Now, recognition of the elements. That means when do I record any element in the financial statements? When do I record any element? I record it when some criteria are fulfilled. First, the item must meet with the definition of the element. We know the definition from the previous slide. So first, if you want to record, it should be either an asset or a liability or an income or an expense, as we discussed earlier. So suppose there is an accounts payable that I want to record. I want to record an accounts payable. It has to first meet with the definition. That means a past event. Okay. Present obligation caused by a past event. Present obligation to for an outflow of economic resources, to settle with an outflow of economic resources caused by a past event should have taken place. Done. Now, that is not alone enough. I have to also ensure that when I'm going to record it, it is providing users with information which is useful. That means the information should be relevant and faithful representation of the element. Okay. So when I'm going to, I know this is a payable, I will record it when I have the relevant and faithful representation. Both of it should match. And the last, we will record it subject to the cost constraint. That means every time we need to look at the cost benefit analysis. Now, whenever we do any kind of project, don't we look at whether it is economically feasible, whether we are going to make profits out of it. Is that not our criteria? Then we go ahead with some projects. Common, correct? Isn't it true?
Yes.
Okay. In the same way, when we are going to recognize any element of the financial statements, you always also have to look at the cost benefit analysis. Am I going to spend a lot of money to produce this kind of information? Much more than the benefit I get by putting that information. So this is a little subjective view based on which you will record. So sometimes if you have to spend too much compared to the benefit you're going to get by recording, you may not be able not record that information.
Can we give an example, madam?
Suppose you're a small, now this applies very often to the small and medium sized enterprises. Now, when it comes to the SMEs, generally, if you see, their accounting is more simple. Why is their accounting simple? Because the costs are less. Comparatively, they can't spend a lot of money in accounting. You agree with me?
Yes.
If suppose you had to do accounting of your, you had to do the recording of your provision for gratuity at year end. What do big companies do? They appoint actuarials who tell you what are the transactions to be recorded. Is it expensive or is it feasible for everyone to afford?
It's expensive.
It is expensive. So now there are some standards under SMEs meant for IFRS for SMEs where they say, don't do the accounting that way, do it in a simple way.
Okay, got it.
So these standards are taking care of it. But basically, when you're recording information, if it is going to be a heavy cost, then you can ignore it. It is acceptable. You can recognize it subject to cost constraint. That means don't go all out to match with the accounting standards, provided you are looking at cost constraint and some information which is not too relevant, you can skip it if the cost constraint is there. But of course, everything is subject to your discussions with auditors who will guide you also in that. Okay. So recognition happens when it meets the definition, when it is providing you information which is relevant, faithful representation, and subject to cost constraint. Now I'm going to the concept of a measurement basis. When you look at all the accounting standards, some accounting standard will tell you record this at historical cost. Another accounting standard will tell you record this at fair value. Another place they say current cost. Somewhere else they use value in use. Somewhere else they use fulfillment value. Now these are the common ways in which various accounting standards will ask you to record the transactions, to measure the transactions. But the meaning of all of that is there in the framework. The framework tells you how to do it. The detailing may not be there in the respective accounting standards. So I'm going to discuss with you the various ways through which measurement takes place. The first common one is historical cost, and the second is called a current value. The current value can be of fair value, it can be a current cost, it can be a current value in use, or it can be a fulfillment value. So when you look at the measurement basis, we have 5 measurement bases that are given to us, and we should be familiar with all of this because in various accounting standards, they may refer to usage of any of these. Okay. So when I look at historical cost, what is historical cost? Can any one of you tell me?
Cost at
Based
which
on past history.
Cost on which it was acquired.
Buying of the
Cost at, okay, for an asset, cost that at which you acquire an asset. Okay, simple words. Amount you pay to purchase an asset or create an asset. Okay, so if you're talking of an asset when it's acquired or created, the value of the cost incurred to acquire the asset or create the asset. So what could be there? You can have consideration paid. You can have any transaction cost. So that means suppose you purchased land, you paid for the purchase price, and you also paid the lawyer. You also paid some stamp duty. You can add all of this, which will give you the historical cost. Simple. Whereas on the other hand, if you incur a liability, like if suppose you issue bonds, if you receive $25,000, so the value of the consideration received is $25,000. But from that, you will minus any transaction cost. So suppose you have to spend any commission or brokerage, you will reduce it, and the net value is the liability. Okay, but of course, this is the guidance given to us basically, but we need to refer to the respective accounting standard to tell us at some times how to record it. So there is an accounting standard on IFRS 9, which tells us in detail how to account for this kind of transactions. So I'm not getting into too much of details for now. I'm just giving you a fair idea of what is it in the conceptual framework. But the accounting standard, if it is giving you a detailed explanation, you need to follow it. It overtakes any explanation given in the conceptual framework. Is that clear?
Okay, so in that case, IFRS will have that importance over this conceptual things.
Yes. So always, if you have any kind of information, any kind of better information, detailed information in an accounting standard, you have to follow the accounting standard. Only when it is not available, we come to the conceptual framework. Okay, that's a basic logic. Conceptual framework is more for where you don't have anything at all. At that time, we come and fall on this and take guidance from when you don't have an accounting standard. It also overtakes, even local laws overtake this. Okay, local laws or an accounting standard overtakes the conceptual framework. Next is fair value. What is fair value? Now again, historical cost is, it is not in your book, but if you go to the conceptual framework, it talks of historical cost over time also. That means updated over time. After 1 year, if you depreciate an asset, historical cost will be the original cost. minus accumulated depreciation. Okay, it talks of if suppose you're having an asset and in the form of a loan and some money is received from the loan, at the end of the year, the value of your asset will be the loan original amount less the installment that you received, net value. Or if there's an interest outstanding, you'll add to the loan. So much detailing is there on historical cost, but it's not that important. And I don't think it's there in your book also to that extent. So I have just given you an idea. Next concept is called a fair value. So when I talk of fair value, there is an accounting standard called as IFRS 13, which deals fully on fair value measurement. It is the price that would be received from the sale of an asset. That means it's an exit price. Very often, we tend to feel fair value should be what you will pay to buy an asset. Okay, very often people tend to feel it is an entry price. No, but fair value is the exit price, what you will receive from the sale of an asset or transfer a liability. In an orderly transaction between market participants on a measurement date. Who are market participants? They are genuine buyers and sellers. So I'm not talking of a transaction made with your friend, with your relative, which might be at a discounted price. If I want to say what is a fair value, it is a transaction or value at which you will sell it to an outsider in the normal market conditions. In an orderly transaction, that means in the market where you get the best price. So if I want to sell a share, we would go to the stock exchange and sell. We would not sell it with anyone else, to any known person, right or no? Because stock exchange is a place where you'll get the best price. So fair value is an exit price, amount you'll receive from the sale of an asset or transfer of a liability in an orderly transaction between market participants on a measurement date. All right. Next concept is called as a value in use. It's a present value of the cash flows or other economic benefits an entity expects to derive from an asset and from its ultimate disposal. Can fair value and fair market value be the same? I have not heard the word fair market value. Where have you seen it, Siddharth Kumar? Can you please tell me? Because the word used is normally fair value. Yes, where have you seen fair market value?
Okay, this is in context with income tax, where we have seen FMB. So I just want to confirm both are not same.
No. Income tax, no. That is different. Based on the tax laws, you will get those values. This is purely an accounting standard, accounting terminology, not tax terminology. Okay.
Valuation of fixed assets.
Okay, fine. Now we come to the concept of value in use. Okay, so it's a present value of the cash flows or other economic benefits an entity expects to derive from an asset and from its ultimate disposal. So I will show you one example to Omega has an asset that has 3 years of remaining useful life. So it has used the asset, now 3 more years are left. And the cash flows that they're expecting from the use of the asset are given to us. They gave us the cash inflows and the cash outflows. The discount rate applicable is 8%. Okay. Calculate the value in use. Have you understood the information produced here? Any doubts, anything given here? Discount rate means you can take it as interest rate. Any doubts on the information produced here?
No.
Okay. Now I'm going to tell you how to calculate a value in use. We write down the years 1, 2, and 3. We write down our cash inflows and cash outflows, and we get a net cash flow. Net cash flow is inflow minus outflow. I wrote it. Now I have to multiply it with a discount rate. What is discount rate? Discount rate is 1 divided by 1 plus R. So discount rate is 1 divided by 1 plus R. Raised to n. What is R? R is the rate of interest, which is 8% given to me, which I must always say as 8 upon 100, which is always taken as 0.08. When I write R in my definition, in my formula, I have to refer to it as 0.08. So 1 plus R means 1.08. And raised to n. N is the number of years. In our question, they told us there are 3 years remaining life. 1 year, 2 years, 3 years. Clear? Understood what is a discount rate? So when I'm on year 1, I write 1 divided by 1.08 raised to 1. In the second year, 1 divided by 1.08 raised to 2. In the third year, 1 divided by 1.08 raised to 3, which I have written here as a formula. And now I get a present value by multiplying the net cash flow with the discount factor. That is how I get my present values. Any doubts up to what I have told here?
No.
Okay. So like that.
Ma'am, I have one question. If there would have been like life of the asset would have been 5 years, so we will add another 2 years into that.
Yeah. Remaining life. Okay. Right up to the disposal of the asset. So like this, I get it. And then I take a total that is said to be the value in use. Clear?
So this will be the fair value of asset.
This is what is written in blue. Read it.
Fair value in use.
What is written in blue? It's not fair value.
It's
What is
value
written
in
in
use.
blue? It is called value in
Value
use.
in use.
Okay. Fair value is different. Value in use is different. Fair value is what you will get from the sale of your asset. So suppose you're having a car, you want to find out the fair value. You will say, if I go to sell the car today, what money will I get? And I'm going to sell it with as a normal commercial transaction, not with some friend or relative, a genuine market. What money you get in the best market is your fair value. But value in use means if I use the asset for the remaining life, what return I get, I'm taking it at its present value. That is value in use. Is that clear?
Yes.
Okay. So value in use is the present value of the cash flows or other economic benefits an entity expects to derive from the use of an asset and from its ultimate disposal. So from the continued use of your asset right up to disposal, all your cash flows will be considered and you will take its present value to get a value in use. Okay. Srinivas, nowadays we don't use arm's length transaction because we want to talk very clearly about a orderly transaction. We also want to talk of market participants. So that is why they skipped that for arm's length and they're using these words to be more clear because they have also gone into more detail on orderly transactions, which market and things like that. Okay. Yes, you can say value in use is NPV, but in NPV, you will have an investment. You start with an investment and then you talk of the returns in the future. But we don't do that for the asset. We only talk of the returns that we're getting. That's the difference. Agree or no, Shraddha?
Yes.
So when we do, so this is just, if you take the NPV without the investment, that is value in use.
Okay. Thank you.
Yeah. Now we come to the concept called as fulfillment value. Just like how you have a value in use, okay, that is always applicable for assets. Very often, a fulfillment value applies to liabilities. fulfillment value applies to liabilities. So it's a present value of the cash or other economic resource an entity expects to be obliged to transfer to fulfill a liability. Okay. So suppose you have taken a loan of 4,50,000 from someone. Okay. And you're going to repay him 4,50,000 in 5 years' time. You're going to pay him back 90,000 per annum. Okay. 5 years. You took a loan of 450, you're going to repay him 450. Now, and you're going to pay him year 1, year 2, year 3, 90,000 each. Now, everything always has a, even if you say 450 you have taken and you're returning 450, someone will say there is no interest. That is wrong. Every transaction has got an interest because there's a time value of money. So I'm going to record its present value. Suppose 7% is the rate of interest applicable. The discount factors I put as 1 upon 1.07, raised to 1, raised to 2, 3, 4, 5. So fulfillment value will be 90,000 into 0.93, 90,000 into 0.87, 90,000 into 0.816, and so on. That means the fulfillment value is 369,018, and the difference between 450 and 369 will be recorded as interest. Is that clear? The present value of the amount you're going to pay to settle your transaction, the present value of the cash or other resource an entity expects to be obliged to transfer in order to fulfill a liability is called as the fulfillment value. Is that clear? These are the 4 concepts. Any doubts on this slide? Again, Naman, I want to tell all of you, when we do a net present value, we will always have an investment in year 0 and we will have the cash flows in year 1, 2, 3, 4, 5.
Okay, ma'am, got it.
Okay, but in this, we don't take into account the investment. Only we take into account the returns. Okay.
Okay, ma'am.
Ma'am, I have one doubt here.
Yeah.
So 3,69,000 we will record in year 0 as my liability, and every year I will revise that value.
Okay, I will show you how it will work. We will record it initially at 369,018.
Okay.
This is the opening, this is the closing balance. Or rather, I call it opening balance. This is called as a finance cost. This is the installment repaid.
Ma'am, this is as per
And this is
NDS
the closing
109
balance.
like that.
Yeah. So I will record
Okay.
the transaction at 369 in year 1. Finance cost is going to be 7% of this. And we repay the installment of 90,000. So the closing balance is the total of the 3. So you can see 369 became 3,04,000. Next year it became 236. Then it became 162. Then it became 82, 84 and became 0. So all this is recorded in the SOPL as finance cost individual years. Debit finance cost, credit loan. Debit finance cost, credit loan, each of the years. Is that clear?
Yeah. Okay.
And here you will say debit loan, credit cash. When it is being repaid. Okay. So that is the concept of fulfillment value. So this completes the chapter 1 and 2. I have one part left, which is on ethics, which I will take immediately after this.
Ma'am,
Yes,
I have
tell
one
me.
doubt. I didn't understand the concept of physical capital maintenance. That is in the.
It's not that important. It is relating to all your capital. Is it there in your book?
Yes, ma'am. Page number 31.
Basically, when you look at physical capital, it is referring more to your use of capacity. What is the capacity you have to manufacture these units? So in that form, we talk of physical. One is the capital, which is the form of share capital and so on. But this is basically looking at your invested capital. What is the capacity, operating capacity of your, how many units can it manufacture? In that sense.
Right?
Pardon?
We will not record in the books, right? It's physical capital maintenance.
No, we don't record in the books, but we may have it in the notes to accounts.
Okay. Yeah. Thanks, ma'am.
Okay.
Hello, ma'am.
Yeah.
Can you just in short explain the difference between fair value and value in use?
What is fair value? Can you read it loudly?
Value that would be received to sell an asset or paid to transfer a liability in orderly transaction between market participant at a measurement date.
So if you have a car, what would you receive from the sale of your car?
As a current date, no?
Yes.
Okay.
What is value in use? What you will receive from the use of the asset. Amount receivable from the use of the asset for the remaining life.
Okay. Okay, got it. Thank you. Thank you. I got it.
Ma'am, just
Now-
want to ask, what is the weightage of these two chapters in the exam?
I don't know. I really don't know.
Approx.
Sometimes they can give you a question, they may not give you at all. Last time they asked on this topic, conceptual framework. Okay. So you should know what you can do is once you solve your past exam papers, don't skip this topic, solve them. You have the revision kit which has got the past exam papers. So on that, every topic there are questions. People tend to miss this topic. That's why I'm telling, solve it, it is good enough. So, solve it and make some notes and use that to write your answers.
Okay, ma'am. Thank you.
Okay. Okay.
Hello.
Okay. Yes, tell me.
Ma'am, one more doubt regarding the development of IFRS standards. In the book, it is written the period of exposure for public comment is normally 120 days. However, in exceptional circumstances, proposals may be issued with a comment period of 30 days. So here, proposals mean the discussion paper or the exposure draft?
Where is it? Which page?
Page number 7.
The comment, whenever they're giving you a comment period, there's always a period of time for comment. So they're referring to those comments.
Yes, but I'm asking if it is for the comment period for discussion paper or comment period for exposure draft.
For anything it can be. You don't need to know to that much of detailing. Don't worry about that. This is not so important that you
No, it was mentioned in the book, so I just got confused.
In exceptions, proposals may be issued with a proposal means it can be for anything. It can be at any stage. You can have less than, if you can have a period of 30 days also. And draft IFRS
I wanted to know if proposals means discussion paper or exposure draft. It can be anything.
Yeah, it could be anything.
Okay.
But he says draft IFRS, that means exposure drafts, are normally 90 days. Okay. Normal so it's 90 days. Draft means exposure draft.
Yeah, but the first sentence says it is normally for 120 days.
It is normally for 120, but they can make it exceptions. When it is coming to a draft, exposure draft, they can say 90 days. Sometimes they can even make it 30 days. That's what they say. That means it's not a hard and fast rule. It has to be 120 days. They could change it. That's what they're trying to tell us.
Okay.
It can.
Yes. Any other doubts? Yes, any other doubts? Can I move to the next?